Let's discuss the cost push inflation and the demand pull inflation. Number one is cost push inflation. Cost push inflation is the result when prices rise as a result of rising cost of input. We know that production is the result of material, labor, and overheads. And if there is an increase in material cost because of any reason, if there is an increase in wage cost, if there is an increase in overheads, it will ultimately increase the production cost. That will lead to the cost push inflation. Cost push inflation may be temporary because of the supply shock. So normally central banks are more likely to leave interest rates alone if the reason is cost push inflation. So what are the reasons of the cost push inflation? Number one is supply shock. Supply shock. A sudden rise in the price level of any commodity, for example oil, can result in the cost push inflation. Remember, after the COVID, there was a sudden rise in the commodity prices. Why? Because there was a supply shock. Demand increases and there was no enough supply in the market. In 1970, there was an increase in the oil prices. That was the result of supply shock. Second is higher wages. As wages rise for workers, company often adjust prices of the goods to keep the profit margin same. With higher costs keeping pace with higher wages, economy is at the risk of entering into the cost push inflation. Third is the imported inflation. For example, you are importing goods from the neighboring country and that neighboring country is experiencing the inflation. So now you have to import at a higher price. That will also result in the cost push inflation. And the last one is higher taxes. If your government increases the value added tax or the GST, it will result in increase in the prices of commodities. That will be the increase of cost of production. Next is demand pull inflation. Demand pull inflation is a type of inflation that occurs when aggregate demand grows rapidly, even outpacing the aggregate supply. So if aggregate demand increases the aggregate supply, that will create the demand pull inflation. When demand rises above supply, this leads to the prices rising to the next level. So that will create the demand pull inflation. So what are the causes that will create the demand pull inflation? Number one is consumption. If consumption and investment rise drastically in any healthy economy, aggregate demand will rise and it will outpace the aggregate supply, which will ultimately increase the prices, increase the inflation. Exchange rate. A dramatic decrease in the country exchange rate. For example, if your current country exchange rate depreciates, it will decrease the imported stuff, but it will increase the exports. When exports increases, the consumption will stop for the imported material. It will rise for the local material. So the local material demand will increase and ultimately it will increase the prices and demand pull inflation will be the result. Government spending. If there is an increase in government spending, it will increase the aggregate demand, which ultimately increase the inflation. Expectation. Sometimes if the companies are expecting that there will be a future inflation, there will be inflation in the future, so company will increase the prices. Worker will demand more wages. Company will have to maintain the margin, so they will increase the prices of the commodities. So that will increase the inflation.